Welcome to the Daily Interview for Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson. There is obviously a lot of volatility for investors right now. The outlook for equities changes sector by sector, and with so many questions over geopolitical stability, supply chains, COVID, inflation, interest rates, there's really no certainty anytime soon. So, how do you invest in such a volatile environment? I wanted to look today beyond just defensive stocks to a broader approach to investing, everything from property right through to crypto, to understand if there's a strategy that might help achieve the best result amongst all the disruption. Evan Lucas is Head of Strategy at InvestSMART. Evan, welcome back to Fear and Greed.
Thanks for having me, Michael.
I mentioned a few of the factors there that are making it such a volatile time for investors. The conflict, obviously, in Ukraine, tensions with China, the Fed lifting rates, pressure on the RBA to lift as well, COVID, an upcoming election. It is a pretty significant list. Is there anything that I've missed there that's just hanging over us?
Inflation. That would probably be the only other one that I'd probably highlight. It's the first time for many, many moons that we've actually had to genuinely think about inflation. And not only that, you talked about the RBA too. Why the RBA is interesting is that there is an entire generation of homeowners that have never experienced a rate rise in their life. So the last time we saw a rate rise was in 2011, and that's 11 and a half years ago. And you think about the amount of first homeowners and even homeowners that have changed homes in that period of time that have never experienced that increase. So I would say inflation is the only thing you've missed on that, but it's there.
Yeah, certainly is. So look, when you're trying to put together a strategy, I mean, we could talk just about equities, but there's enough in that just for an entire conversation on its own. So I want to kind of look beyond the ASX. But before we do that, what should equity investors be looking at right now? Just a bit of a 101 on risk management.
Yeah, so I think all of that together, including your volatility question and what have you, why I look at this is the way to start and the way to talk about this is time. And why I say time heals all. That needs to be your adage when you're investing in anything. If it's cash products, fixed income, equities, property, crypto, it doesn't matter what it is, it's time. And why I say time needs to be defined in your strategy before you start. Am I investing for tomorrow? Am I investing for the end of the year? Am I investing for 5 years, 10 years, 20? And the reason I say that is time will very much override volatility whenever you start extending it, because that is what we know. So why I say that, let's try and do some examples. I don't want to look at COVID in 2020, and I also don't want to look at sort of 2007 with the GFC. I think the years you need to look at something like 2018, very insignificant year in terms of what we think of with regards to investing and what happened. But why I say that, everything that you just mentioned before, Michael, RBA, Fed liftoff, China tensions, blah, 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 happened in that year, and we sort of forget that. And so if you go back and have a look, the one that always sticks out in my mind around it is that in October 2018, on about the 5th of October, the newly minted Jerome Powell was at a meeting and was having a very big interview with CNBC, and he had a grin on his face like a Cheshire cat about how perfectly positioned the US economy was in. And the suggestion out of that was that rates were going to rise. And the reaction off the back of that was for the S&P 500 to fall 24.5% from basically that speech to Christmas Eve of the same year. And volatility went from severely complacent, which is about 10 to 12 index points on the US VIX, up into the mid-50s and even went as high as touching 70 in that speed. So why I want you to highlight that is that was 2.5 months of trading, lost 24.5%. But then if you look from that point, from that bottom on the 24th all the way through 2019 before COVID, the S&P jumped up 63%. So that is very, very short. And not only that, what should also be highlighted, that's another volatile period just to the upside rather than to the downside. So then if you look at the 10 years, we go back just before the GFC. You've got things like the Euro crisis, the China hard landing. You then had the 2018 and you have COVID and where we are now. If you look at the S&P 500 over those 10 years, it's up over 400%. So this is what I mean by time. Time in the market will always outperform short-term issues. So yes, the RBA can lift rates. Yes, the Fed is lifting rates and will lift them higher. Tensions with China will remain, and the horrible events in Ukraine are certainly there to be had. And whatever happens in 2022, I will put my hand up and say, I don't know, but I do know that longer term, if I'm investing, I'm not thinking about now. I'm not thinking about Christmas. I'm thinking about what 2027 looks like, really. And what does 2030 look like, or 2032 look like in terms of where I sit? Now, that's because I've got a longer term view. But why I want to say that is, again, let's look at the ASX. On a total returns basis, so that's including the dividends you get paid and reinvesting them back in, if you look at where that has come over the last 5 years, you're up about 70%. If you look at where it is since 2002 to where we are today, 20 years ago, it's 408%. But again, it's just a question of times with regards to how you look at it. And so, yeah, your question about volatility is this: can you look through it? Can you accept 1-2% movements intraday, intra-week when your strategy is long-term? And if you can start to think of it that way, you'll be able to actually look through volatility. So my final point on this is this: expect the unexpected in the short term, expect in the long term some more certainty. Final stat: if you take every 20 cut years in the S&P 500 all the way back to 1900, you are 100% more likely to be up than down in each of those 20-year cuts. And that is a stat that the S&P will love telling you. And that is statistically true. And that's why, with all those events that we've just talked about, volatility is a short-term problem, not a long-term one.
Can I ask you about gold then? Because gold has a reputation for being a safe haven during a crisis. Is it living up to its name at the moment? I mean, we do seem to have lurched essentially kind of from one crisis to the next when you kind of think about the list. But has it kind of lived up to its name as a safe haven during that time?
Gold is not what we used to think of it's in terms of the 70s, 80s, 90s, and even the early 2000s. Like, it is that safe haven thing, and it's the store of value and obviously a hedge against inflation and all those kinds of things. There's more pressure on gold these days. There's more inputs on gold these days, what we call paper trading. So using things like exchange traded funds or, gold contracts versus physical. Because when you look at that, there's two different players that get involved in the difference. So physical, the Chinese and the Indians are the biggest investors in physical gold. But when you look at paper trading, it becomes more global, and players like Japan, the US and Europe tend to be there. In answer to your question, to some extent, in the last couple of years, you probably would say yes. Again, you look at the reaction to gold in 2020 and making a record all-time high into sort of the $2,200-$2,300 US dollars an ounce, then eases back. I think the reason I'm hesitant of it is gold movements are much stronger than they used to be. They can move quite quickly in hundreds of dollars. Again, if you look back over history, you look at the movement to when it got to $1,900 US dollars an ounce during the GFC. It then crashed $800 US dollars an ounce over the preceding couple of years. So it's not as easy as it once upon a time used to be. When the gold standard was about it's a store of value. It's in a hedge to inflation. It's different now, and people use it for all range of different things. Again, sometimes people forget gold also is quite usable these days with regards to conduction and using in technology. So a lot of gold leaf and gold material is used that way. So its demand is higher than it used to be as well. I think all of those factor into why gold's not the same as it once upon a time was.
Stay with me, Evan. We'll be back in a minute. My guest this morning is Evan Lucas, Head of Strategy at InvestSMART. You mentioned gold and the perception of it as being a hedge against inflation. Crypto has also been talked about in some cases in a similar way. We've seen, obviously, crypto investors would be no strangers to volatility, but we've actually seen some really good gains in recent weeks for most of the main cryptocurrencies. What is kind of pushing that? And obviously, we've heard in recent weeks about there being more talk of regulation. Is that helping them to become less volatile in their own right? And I suppose then there's turning into a triple-barreled question here, but has crypto become a good way to catch the upside of disruption?
Oh, huge questions. Okay, first and foremost, it depends on how you defined movement. So let's look at Bitcoin, because I think that's the easiest one to start with regards to where we sit. Yes, it's highly volatile, and I would still say it is. It has moved from low 30,000s back into the mid to high 40,000s, back into the low 30,000s, on and off. So $10,000 movements for the last 6 months. Yes, it slowed down in the last couple of weeks, but if you look at what happened at the start of the Ukraine crisis, it fell like a stone and then took off. Now, that sort of comes to the next part of your question. What do I think is pushing it around? Well, it's also, the biggest providers and users of cryptos tend to be frontier markets, tend to be frontier countries. You'd have to make an argument that there's been big movements around how particularly Russian rubles are being exchanged, and where Russia is now using and using exchanges to move around. There's no doubt that they are involved. They're not obviously the main player, but they're part of it. Regulation is the next one. How do you regulate it, and what does regulation come into it? The reason I say it in that sort of response is there is more and more signs that regulation will probably be, could they actually look at doing blockchain technology for traditional fiat currencies? And that I think is more likely, because then you are going to actually get the populations globally to start adapting and using it more. Like what brings it mainstream? I mean, it's certainly an amazing speculation product. People have made incredible amounts of money out of it, and congratulations to them. But it is still, in my eyes, it's not mainstream. It's not, inverted commas, a true currency. Because again, getting back to this whole discussion, is about store of value, inflation, etc. It's not a hedge against inflation. That is clear. And I don't think anybody that tries to argue that is really understanding the point of a store of inflation. The next one is a store of value. How can you use a currency, an actual transfer of what is technically a currency? It's just an IOU. Here is a good, and here is an exchange of fund an IOU for X amount of dollars or X amount of currency of crypto, what have you. You can't be doing business with a value product that can move, 10, 12% per day. It means that this podcast is a great example. The subscriptions that come to this tomorrow could be 12, 10, 20, or even as much as 30% they've moved in the past, percent lower in value, or 30% higher in value tomorrow. It's impossible, therefore, to do contracting. If you look at things like infrastructure projects, how could you use cryptocurrencies to use a 10-year infrastructure project and pay for it in that? Because the value can just not be forecasted and cannot be stored, which is why we know what the Australian dollar is going to be roughly worth, or what we know the US dollar will be worth. And therefore, it's an easier ability to then go, here's my Australian dollars for that coffee, here's my Australian dollars for that service, here is my Australian dollars for that good. Cryptos aren't that yet.
Okay, we are rapidly running out of time, but just trying to put together an overview, really, of kind of how to manage this element of volatility and risk throughout kind of turbulent times. But we've covered crypto, we've covered gold, and really we've covered equities. What about property then? Because property is obviously subject to its own kind of form of volatility, and some of those factors that we've talked about in terms of interest rates are obviously having a major impact on the market, and we are seeing it start to slow. How should we be looking at property at the moment as a form of investment?
Property is no doubt slowing down. The thing about property markets is that it's the most tangible market out there. It's the most hands-on, touchable market you can have. You physically can change your house. You can physically paint it, do what have you. The other thing that's interesting about property as well is that, unlike every other market, it doesn't have a daily price on it. You don't go home to your house every day with a big neon sign on the top of it saying, today it lost 10%. It went from being worth, the median house price in Australia is 660,000. Today it's now worth 650. You don't get that, or vice versa. And the advantage for that is that therefore people don't panic sell. They don't get caught up in the emotion of volatility. The other thing though, particularly in slightly volatile times, or what your question more is, Michael, is that, we've got a raising interest rate environment, we've got a slowing environment, we've got a fairly fully valued property market. Prices will come down. But what will also tend to be is that in the property market, what's slightly different is that people can continue to live in their homes, or people can continue just to hold on to their investment property. So instead of there being a fall and a fairly significant crash in the market, what happens is a simple economics: supply dries up because people don't want to sell into a market that's falling. So all of a sudden, we're starting to see this already. Demand is dropping off because prices are expensive, interest rates are rising. You look in Sydney and Melbourne for the first time for ages, they're actually starting to see a sustained decline in pricing. Do not be surprised, therefore, to see supply to start falling away because, as I said, people just don't want to make a loss on it, and therefore they can sustain holding on to their home or their investment property for longer. So that's what tends to happen in property. Property is slightly different because there are other inputs into it. So no doubt affordability is the biggest problem right now. That is clear. When you look at the rises in prices versus the rise in wages, the affordability crisis, and that's the correct word, is certainly driving that, and now interest rates. What will be the next driver from my perspective is supply, and it will therefore moderate the declines. I don't expect some forecast of crashing. It doesn't happen like that. It could certainly decline by 10%. It's not going to decline by 30% like some people are forecasting, because nobody's going to start selling their property if prices go that high. And then you're still going to have demand. People still are going to need a new home, are still going to want a new home. So demand will still always be there. So when those properties come up, they will still have a level of demand to keep prices relatively strong, even in a falling market.
We started the conversation talking about time. And so I'd like to finish with infrastructure and bonds, kind of in terms of these have a reputation for obviously stability, but most people really their greatest exposure to these asset classes is probably going to be through their super fund. How should people be looking at their super right now? And in doing so, thinking about infrastructure and bonds as probably the most, that their super fund being the vehicle through which they're going to be able to have some exposure and interaction with those classes.
Mm-hmm. I'm just going to take that a little bit further as well. The other advantage of super, getting back to the point you made about time, is that part of the way to play with volatility and part of the way to look through it is to basically be constantly adding to your investment. If you can look through time, it's called dollar cost averaging, where right now, or actually they're not, but in the ASX example, but when markets are down, if you're just constantly adding to your portfolio, the average price of your overall cost base will drop down or drop up. But if you're constantly doing that, it then gives you just the year 10 maths we all learn about compound investing and compound interest, and it just helps you that way. So, but getting back, so the advantage of super is that you're forced to do it. That's the incredible thing about super, is that why Australia is so far ahead from most other countries is because you are forced to put 9.5%, going up to 12% over the next 3 years into your investments. So looking at infrastructure and looking at bonds, the advantage of infrastructure is that they are incredibly long-term projects. They are big and have a decent return. If you look at what infrastructure returns, it's about 3 to 4% per annum, and that is a great advantage. And that doesn't matter through almost anything, because infrastructure is always needed. We always need better roads, better airports, better trains, blah blah blah. Not just that, you then have other things as well that come inside the infrastructure space. And super funds have worked that out. That also sits inside their mandates, that they need them because they're such a core part of their defensive side of their portfolio. So infrastructure is what it is on one side. Let's have a look at bonds though. Bonds are a really interesting asset class right now because they're actually losing out. So higher interest rates certainly not helping them. People know rates are going higher and they're shedding them. You've also then got, and I don't have time to talk about this too much, but the differential between, bond yields and real yields. Real yields are actually negative. And by real yields, that's when you include inflation. So most yields, even the best ones out there, stuff like 10 years in the US, etc., they're 2.5%, 2.7% in Australia, what have you, it doesn't matter. Once you put inflation in that, they're actually a negative response. So you're actually losing money just through inflation, degradation. And that's why bonds of late has been a really, really talked about subject, because they are supposed to be seen as this, absolutely conservative opportunity. The other thing I would say, don't forget a fixed income bond which is what I would refer to as something that has capital growth and also a yield component, whereas a cash component is something like a term deposit that doesn't have a movement in capital. And the capital price is being eroded as well. So investors keep asking that question, why should I hold bonds? Because over the last couple of years, they've been really savaged. Thing is, though, again, like any other market, if you look longer term, bonds have actually done pretty well leading into 2018. In fact, they were doing returns that were the same as equities. So it's just that question you've asked me before, Michael, which is time. It just depends on when you're looking at time. And there are some arguments to be made that if you're looking longer term, bonds are trading at quite high discounts. And that's why people will tell you and continue to tell you that investing in them is still has an advantageous longer term view, because they are discounted to their face value, and that therefore will sooner or later come home to maturity, and therefore you'll get paid that difference.
All right, Evan, thank you for talking to Fear and Greed.
Thank you, Michael. Thank you for having me. That was a lot there. So I'm very, very appreciative for having me on.
No, I think it's very comprehensive, and really the take-home message is time.
Time.
That's it. All right, that's Evan Lucas, Head of Strategy at InvestSMART. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson. Have a great day.